Let's focus straight up on the hospitality sector. Sanjay Sethi, the managing director, as well as the CEO of Chalet Hotel, joins in. And Amit Jaiswal, the CFO of Royal Orchid, as well, joins us to discuss demand trends, occupancy levels, and the overall business outlook. Well, good morning, gentlemen. Thanks so much for joining in. We have been trying to book rooms. It's been rather difficult. So I guess it's spelling very, very good times for your businesses. So I'm guessing things are really on the uptrend. But Sanjay, let's come across to you first. Occupancy in the first quarter itself was already around 78% odd. Have you managed to maintain that? What's the occupancy level? And also the revenue per room, if I'm not mistaken, was at around 5,800 rupees odd. Do you see this number trend higher? If yes, where does it go? Go ahead.
So thank you. Good morning, everyone. Pleasure to be on CNBC again. Yes, I think the occupancies are doing extremely well. The quarter one occupancies were on the back of IPL business, which sort of ended on 20th of May. And after that, the occupancies have hovered around the low 70s, 72, 73 mark. And that seems to be the trend that we saw in July. So June and July continued on that trend. And they stay clearly well above pre-pandemic numbers for similar months. Overall, I think the business is trading higher than Q1 and Q2 of FY20. Both rates and occupancies look good. F&B business has grown very aggressively, and we're very excited about what the future holds for us.
Right, but Sanjay, what about the room rates? The average that you gave us was around 5,800 in the first quarter. Occupancy is better than pre-pandemic levels. What was the peak of room rates in the last few years, say in the last 5-8 years or so? And how do you see this moving? Go ahead.
So one correction there, our room rates were not 5,794.
Okay.
Our room rates were actually, average room rates were 7,457.
Okay.
The RevPAR, which is rate per available room,
okay,
revenue per available room, was 5,794. This was on the back of strong occupancies and rates catching up with pre-pandemic numbers. I think what's really affecting the rates right now is the revenue mix. Most of the revenue is coming from the domestic business travel. Once the international business travel kicks in, the revenue mix will improve to give us higher rates. You asked about what were the rates, historically, are we at peak rates? Yes, we are not. I mean, 2008, 7 and 8 were the peak rates for the industry. I see that as good news because that shows there is a headroom for growth, and the future growth could be rate driven as against occupancy driven, because occupancies are peaking out in most cities for some days a week now.
All right, gentlemen, good morning and thanks for joining us. Let me also bring Mr. Jaiswal into this conversation. So, Mr. Jaiswal, the same question to you. What is occupancy looking like for you right now? And can you take us through what it could be for Q2? Like Mr. Sethi was pointing out, it's definitely picked up across cities. Q2 is also the time when you have a lot of these festivals. So what is occupancy likely to look like for the full quarter?
Yeah, hello. See, occupancies have reached its peak. I can tell you, see, as Nigel rightly said, 78% around occupancy is there. And let me inform you guys that we are maintaining the same run rate even in Q2. And probably in the Q3 and Q4, it can go up by 2-3% more. Okay, because historically the season for our industry is Q3 and Q4. So that is as far as occupancies are concerned. And as far as the ARRs is concerned, yes, let me tell you, we have seen the highest ARR in last decade in the first quarter. And we are very hopeful that in third and fourth quarter, there can be an upward movement of ARR by 10 to 15% further. This is all about our company.
Okay. Mr. Sethi, can you also break up the revenue in terms of, events and rooms, etc., and also, between your hotels and rental properties?
Sure. Samira, Q1 numbers, if you look at for the year right now, roughly 62% of the revenue came from the rooms division, and the balance came from a mix of F&B and other revenue. Within F&B, there was banquets, which was about 40%. So 80 crores of revenue came from banquets. from F&B, and roughly around 40% of that, that's 32 crores, came from the banquet division, and largely driven by the MICE interventions that have happened. I would like to highlight here that whilst the room rates haven't grown at the pace that they could potentially have, because all our portfolios in big cities and not in the leisure destinations, that's good news actually for us, because the headroom for growth remains very robust. So we've had a very good quarter, and the rates haven't peaked out as yet. Is a great story. H2 will clearly be very strong, and I think next year looks like quite a phenomenal year on the rate growth front, with most of the hotel companies targeting RFP rates at 30 to 40% higher than the pre-pandemic rates. Overall, 90% of the business came from hospitality division for us, 10% from the annuity side of the business. And the annuity side is looking very, very strong. I just want to give you a quick snapshot. We have 2,554 rooms now. We have now clear visibility of adding another 1,050 rooms. That's 41% growth on the existing inventory, and this is all going to come in the next 2.5, 3 years. And this is what we have visibility on, firm visibility on. There could be more. On the non-hospitality side, we have roughly around 550,000 square feet on rent, but we have 2.5 million square foot under development. So that could grow up exponentially, adding to stable revenues and very high beta margins to the business.
Okay, all right. Sanjay, let me probe on that point a little bit more. How does the mix change? You have both the segments. You have more number of rooms coming in there, and you have high number of square feet as well to lease out. 88, 90% comes in from hospitality. How do you see that mix change going ahead between, the rental lease revenue as well as hospitality?
I think short term, the annuity business will move from 10% to 25% of the revenue, and EBITDA share could be slightly higher. But in the mid-term and long-term, hospitality will grow far more aggressively, and therefore we should be back to roughly around an 80-20 mix in the mid-term.
Okay. Mr. Jaiswal, if I can come back to you now, if you could just clarify what is your occupancy right now. I know Chalet's at 78. That is for Chalet Hotels. What is the occupancy for you right now?
We are doing around 80% occupancy.
Around 80%. Okay. Could you also tell me, in addition to travel, we have been talking about weddings, events, conferences, all of these also coming back in full force. Can you tell us how much of your contribution is from this?
See, as far as Royal Orchid is concerned, we are focused a lot on our F&B business, and our 33% of the revenue, of the total revenue, comes out of the F&B. And out of this 33%, almost 50% comes out of the banqueting business. That's wedding and all. We have very good destinations which are doing very well as far as F&B is concerned. And we are looking forward to further growth in our F&B business in the last 2 quarters, because in this quarter 2, the sour dates, which we call the wedding dates, are lesser. So in 3 and 4, the wedding dates are quite high. So we are looking forward to our exponential growth in the the wedding business also.
So how much could the revenue mix get to, for going forward for all of FY23? What do you think the revenue mix could get to for F&B and then the rest of the business?
See, rest of business, in Q1, our mix is 58% comes out of room revenue, 33% comes out of the F&B, and balance is the other sources of income is there. So we are looking forward in the, in going quarters, 35% out of our F&B, 60% out of the rooms, and 5% from the other means of, revenues.
All right, Sanjay, final question then. Growth is good. Both of you gentlemen are sounding very, very optimistic. Me and my co-anchors will have to rethink about our travel plans, because both of you are indicating room rates are going to go up. But be that as it may, debt in the books. You are planning on doing some refinancing, I believe. And given that you have such ambitious expansion plans, could you give us a sense about net debt? I believe at last count, it was around 2,200, 2,300 crores odd. But you have some capex as well that's coming on stream. So peak debt levels, what will it look like?
I think the peak debt will happen by end of this financial year at about 2,700 crores. But all of it is going through to growth capital. Now, look, a lot of people think of debt as bad. I think right and balanced amount of leverage is actually great for the business, because it allows you to grow. So we are not averse to debt as long as it's sustainable. It allows us to grow at an express pace, and the whatever assets that we build out of this debt are high-yielding assets. So if that works for us, there's no reason why we should be conservative about debt. And let me just highlight, it's only India that's averse to debt. The rest of the world actually likes debt.
Okay, all right, very valid points. Sanjay, in a business looking up, you're going head on and trying to expand, and it's a good business out there. Final question, Mr. Jaiswal, before we let you go, you have been talking about selling some non-core assets in India, I think in Tasmania as well. Any progress on that front? Now the market has revived. Now you should be able to sell it, right?
Yes, Nigel, as you know, in the fourth quarter of last year, we had sold our Powai land, and we had acquired the 50% stake in our Goa hotel, which was, we were holding 50% earlier. Now it is 100%. And that is one very good part of our dealing with the debt asset and investing in the, the money-making asset, and which we have seen in the first quarter itself, that Goa has done very well. So going forward also, we have another asset in Tanzania, which, our MD, Mr. Balji, is hung on to do some deal there and bring in that money and reduce the debt which is there in the standalone. Although let me tell you guys that we have been able to reduce our interest cost by 2.5% as we got the debt refinanced last year. And so interest cost has come down, although we are looking forward to making the company debt-free. That's our goal, that we should make the company debt-free.
Well, Mr. Sethi, Mr. Jaiswal, it's been good chatting with you all. Thanks so much for joining in. Clearly, both of you all are sounding rather optimistic on business, expansion plans, and, room rents are moving up, occupancy levels as well higher. Things looking good for your industry on the whole. For the time being, though, we'll slip into a short break. Up next, we'll get Avisar Jain, Head and Fund Manager at Monarch AIF. He'll be joining in. Remember,